The moment you enter a trade, something extraordinary happens in your mind. You're no longer simply a person observing markets from a distance. You become intimately entangled with the position, and in that entanglement, your psychology transforms in ways that are both predictable and profound. The question of why traders close positions early, why they abandon potentially profitable trades before their thesis has fully materialized, is not merely a tactical problem to be solved with better rules or tighter discipline. It is a window into the deepest mechanisms of human decision-making under uncertainty. And understanding it requires that we travel far beyond the surface explanations of fear and greed that dominate casual trading discourse. When you initiate a trade, you are making a declaration about the future. You are stating, with your capital, that you believe price will move in a particular direction based on your analysis, your edge, your understanding of market structure. But the moment that position is live, the moment your capital is at risk, you transition from the realm of analysis into the realm of experience. And experience, as any seasoned trader knows, is vastly different from analysis. In analysis, you are calm, rational, methodical. In experience, you are flooded with sensory information, with emotional responses, with the visceral feeling of money moving in real time. This transition is where the first seeds of early exit are planted, because the emotional intensity of holding a live position is something that almost no amount of preparation can fully anticipate until you have lived through it repeatedly. The psychology of holding trades is fundamentally about your relationship with uncertainty and discomfort. Every moment you remain in a position, you are existing in a state of not knowing. You do not know if the trade will work out. You do not know if the market will validate your thesis or invalidate it. You do not know if the profit you currently see on your screen will grow or evaporate. This state of not knowing creates a profound psychological tension, and human beings are neurologically wired to resolve tension as quickly as possible. We are uncomfortable with ambiguity. We seek closure, resolution, certainty. This is not a character flaw. It is an evolutionary adaptation that served our ancestors well when uncertainty often meant physical danger. But in trading, this same mechanism becomes a liability, because the market demands that you sit with uncertainty for extended periods if you want to capture meaningful moves. Consider what happens neurologically when you see your trade move into profit. The moment you see those numbers turn green, your brain releases dopamine. This is the neurotransmitter associated with reward, pleasure, and reinforcement. You feel good. You feel validated. Your analysis was correct, and your brain is celebrating this small victory. But here is where the trap emerges. That dopamine hit is immediate and real, whereas the potential for larger profits in the future is abstract and uncertain. Your brain is wired to prefer immediate, certain rewards over delayed, uncertain ones. This is the essence of temporal discounting, a well-documented cognitive bias. So when you have a modest profit showing, your nervous system is essentially screaming at you to take it, to lock in the certainty, to secure the dopamine hit now, rather than risk losing it by waiting. This is not weakness. This is your neurobiology doing exactly what it was designed to do. The problem is that profitable trading often requires you to override these deeply embedded responses. But the neurological dimension is only part of the story. There is also the psychological weight of regret, and this weight is enormously powerful in shaping trader behavior. When you close a trade for a small profit and then watch it continue moving in your direction, achieving the target you originally envisioned, you experience regret. But when you hold a trade, watch it go deeper into profit, and then give back some of those gains before ultimately closing for less than the peak, you also experience regret. The human mind is exquisitely sensitive to regret, and we will often structure our behavior not to maximize gains, but to minimize the possibility of feeling regret. This is why so many traders develop the habit of taking profits quickly. It feels like a form of protection against the specific regret of watching profits disappear. What they fail to fully internalize is that this strategy creates a different kind of regret. The regret of never allowing winners to fully develop. The regret of systematically cutting short their edge. Both paths involve regret, but one path is compatible with long-term profitability, and the other is not. There is something else at play here, something more subtle and more insidious. The shift in your reference point once a trade moves into profit. Before you enter a trade, your reference point is your current account balance. You are risking a percentage of that balance in pursuit of a gain. But the moment the trade moves into profit, your psychological reference point shifts. Now, you are no longer thinking about your original account balance. You are thinking about the current floating profit as something you possess. That unrealized profit becomes in your mind your money. And now, The prospect of the market moving against you and taking away some of that profit feels not like a normal market fluctuation, but like a loss. This is prospect theory in action, the groundbreaking work of Daniel Kahneman and Amos Tversky that revealed how losses loom larger than gains in the human psyche. Once you mentally categorize floating profits as your money, you become loss-averse regarding those profits, and your tolerance for normal market volatility plummets. A pullback that you would have easily weathered before entering the trade now feels intolerable, because it represents a loss from your new reference point. This reference point shift is particularly dangerous because it happens unconsciously and rapidly. You don't deliberately decide to change your psychological framing. It simply occurs as a natural consequence of seeing your account value increase. And once this shift happens, your entire decision-making framework changes. You begin monitoring the trade obsessively, checking it constantly, watching every tick. This is not due diligence, this is anxiety. You are no longer managing a trade based on your original thesis and plan. You are managing your emotional relationship with the floating profit. And when you are managing emotions rather than following process, you have already lost the psychological battle. The decision to close early becomes almost inevitable at this point, because you are seeking relief from the anxiety rather than seeking alignment with your trading edge. The concept of identity also plays a crucial role in the psychology of holding trades. Every time you close a trade early and it continues moving in your direction, you are not just missing profits. You are reinforcing a particular identity. You are becoming, in your own mind, the type of trader who closes early. You are strengthening the neural pathways associated with premature exits. You are building a self-concept around impatience and discomfort with winning. Identity is extraordinarily powerful because it operates at a level deeper than conscious choice. Once you identify as a certain type of trader, your behaviors will unconsciously align with that identity to maintain internal consistency. This is why affirmations and positive thinking alone rarely create lasting change in trading. You cannot simply think your way into a new identity while your behaviors continue to reinforce the old one. The only way to build a new identity is through repeated action that contradicts the old identity. Action taken despite discomfort, despite fear, despite the overwhelming urge to seek immediate relief. Let us examine the role of control in this dynamic, because control is perhaps the most misunderstood aspect of trading psychology. When you close a trade, you are exercising control. You are making a decision, taking action, determining an outcome. This feels powerful. It feels responsible. It feels like you are actively managing your risk and your capital. But here is the paradox. In trading, the highest level of mastery often involves surrendering control over outcomes while maintaining absolute control over process. You cannot control where price goes. You cannot control whether this particular trade works out. You can only control your adherence to your plan, your management of position size, your response to market information. But surrendering control over outcomes feels terrifying to the ego, because the ego is invested in the illusion that it can control external events through sheer force of will and attention. So when you close a trade early, part of what you are doing is reasserting control in a domain where control is largely illusory. You are choosing the outcome rather than allowing the market to determine the outcome according to your predefined criteria. This feels safer, but it is actually a manifestation of fear masquerading as prudence. The environmental context in which you are holding trades also matters enormously. If you are trading in isolation, without meaningful accountability or structure, the psychological burden of holding through discomfort is borne entirely by you. There is no external force preventing you from clicking the close button whenever anxiety spikes. This is why professional traders often operate within institutional frameworks that include position limits, mandatory holding periods, and external oversight, not because they lack skill, but because they understand that psychological discipline is a finite resource that gets depleted throughout the trading day. The retail trader, operating alone, must build their own structures to replace the external scaffolding that institutional traders take for granted. This might mean committing to not checking trades for specific time intervals, using technical stops that remove discretion, or creating accountability through trading journals or peer groups. The specific mechanism matters less than the recognition that willpower alone is insufficient for consistent execution. There is also the temporal dimension to consider. In our modern trading environment, where information flows continuously and price updates tick by tick, we are subjected to an overwhelming amount of noise. Every small movement against your position triggers a micro-response in your nervous system. Every pause in momentum toward your target creates doubt. This constant stimulation wears down your resolve gradually, in the same way that water erodes stone, not through a single catastrophic event, but through persistent, incremental pressure. The trader who can hold positions successfully has typically developed the capacity to zoom out, to see the current price action within the context of the larger timeframe thesis, to recognize that volatility on the minute chart is completely irrelevant to a daily chart setup. But this capacity must be developed deliberately. It does not emerge naturally, because our attention is magnetically drawn to movement, to change, to immediate stimulation. Learning to hold trades is, in many ways, learning to direct your attention skillfully rather than allowing it to be hijacked by market noise. What separates the developing trader from the mature trader is not intelligence or knowledge of technical patterns or access to sophisticated tools. It is the capacity to experience discomfort without immediately acting to relieve it. This capacity is not mystical or innate. It is a skill that can be developed through practice, but it requires a fundamental reframing of what discomfort means in the trading context. Most traders interpret the discomfort of holding a position as a signal that something is wrong, that danger is present, that action must be taken. But discomfort in trading is often simply the feeling of being in the game. It is the sensation of having something at stake. It is the emotional texture of uncertainty. When you can reframe discomfort from a warning signal to a neutral sensation that accompanies exposure, you remove much of its power over your decision-making. This is not about becoming emotionless or detached. It is about developing a different relationship with the emotional experience of trading. The deepest insight about holding trades may be this: the inability to hold is not really about the market at all. It is about your relationship with yourself, your trust in your own judgment, your willingness to commit to a course of action even when your nervous system is demanding that you abandon it. Every time you close a trade according to plan, regardless of whether it was ultimately the optimal decision, you are building trust with yourself. You are demonstrating that you can make a commitment and honor it. And every time you close a trade impulsively out of fear or discomfort, you are eroding that trust. Over time, this erosion of self-trust becomes the primary obstacle to development because you can no longer believe your own commitments. You know from experience that when things get uncomfortable, you will likely abandon your plan. This knowledge makes it almost impossible to execute with conviction. And trading without conviction is trading without edge. The path forward requires that you begin keeping small promises to yourself, holding positions according to predefined criteria even when they are modest, building evidence that you are capable of following through, reconstructing trust one trade at a time until holding becomes not an act of heroism, but simply what you do.